If you handed me $1 million portfolio right now and said, Diego, sort it out, I wouldn't touch a single trade. Not one, not yet. Because before I move anything, there are 3 things I check every single time. And even if one of them is off, I don't make a move. Make sure you watch all 3 because number 3 is the one that surprises people the most. And it's the one almost nobody actually has. So let's get right into it. Here's the first thing to understand. Almost everyone gets this backwards. So retail obsesses over what to buy, the next coin, stock, the next hot pick, the next thing pumping on their feet. That's the noise. The professionals, the people moving real money, institutions, smart money, barely think about that until the very end. They check the structure first. They check where we are in the cycle. They check whether there's an actual plan. And then the pick is maybe the last 5% of the decision and not the first. So that's how I want you to watch the rest of this video through that lens. So here's exactly what I personally run through. Check number 1, how the portfolio is actually built, so what you're holding and why. Check number 2, where we are in the cycle and whether the portfolio even fits the moment we're in. And check number 3, the one almost nobody has, whether there's a real written plan for the next exit and the next entry. 3 simple checks, but you'd be amazed how few 6- and 7-figure portfolios pass all 3. Let's go through them one at a time. Check 1. So before I think about a single trade, I want to see the skeleton, not the headlines, not the watch list, the actual structure of the portfolio. Because the structure of a portfolio decides your outcome far more than any individual pick ever will. So these are the questions I'd be asking you in the first few 10 minutes. So first one, that would be, are you 100% in crypto or in any other asset class? Because personally, I would never want to be all in one single asset class. And for me, that's not conviction. That's just a risky bet. And you're betting your whole position on that one asset class, especially with crypto, where there is times you shouldn't hold any crypto at all. For example, from September of last year to later this year when we start accumulating again. Then another question would be, how much do you have in cash? Or why do you own what you own? And can you actually answer that? Or did it end up in there because someone on X or YouTube said so 2 years ago? Are you tech heavy? Are you metals heavy, value heavy? And how do those risks actually compare to each other? Then the big one, does your allocation even make sense for your goals and your time horizon? If your capital is heavily concentrated in tech or crypto, you have to specifically understand macro regimes, which is the next check I'm going to cover. Because different asset classes carry hidden risks that catch retail off guard. For example, you might buy gold as the safe haven standard, guaranteed, at least that's what they say. Because when a recession hits and a liquidity shock occurs, even gold can crash. Because initially, in the beginning, the traders, investors, they need liquidity. So the first thing they might sell could be gold. So even during a US recession, initially in the beginning, it could be very well that gold crashes. So you need to understand why that happens and what it means for your capital when it does, so you are never caught by surprise. It all comes down to aligning your vehicle with your destination. If your goal is to scale from, let's say, 1 million to 5 million in about 3 years, so that would be a pretty fast pace, slow-moving value stocks are likely the wrong play. So you wouldn't be buying Berkshire Hathaway, right? And crypto, in this case, could be significantly more interesting, but going all in or adopting a passive HODL mentality is an absolute failure of risk management too. So with highly volatile assets like crypto, you must understand the broader cycle and the key macro indicators required to time the major tops and bottoms. And that is how you profit from massive volatility instead of getting crushed by a 80% drawdown. By the way, this is exactly what we provide at Sonderberg Research. If you need help one-on-one, there's a link below in the description or pinned at the comments where you can book a one-on-one strategy call with me. So look, I don't just preach this framework, I execute it transparently. over the last few years. I've shared some of our largest trades publicly here on YouTube, on X. And my latest notable execution, for example, was the 120K short at the peak in October, or the recent one where we initiated a short at 82K just a few weeks ago in the liquidity range, targeting a move below 60K, which actually just happened. So I don't share those executions to boast about catching tops. I share them because when those decisions were made, there was zero emotion involved. So I wasn't staring at 5-minute charts. I wasn't day trading, and I wasn't scrolling social media for confirmation buys. I was simply executing a pre-planned systematic framework based on macro liquidity and structural limits. So when you're managing 7 figures, you cannot afford to treat your portfolio like a secondary casino. You have to treat it like a business. And just like a business needs to understand, needs standard operating procedures to scale, a portfolio needs a rigid framework to survive. So you must understand the vehicle you are using, confirm that it actually fits your personal risk profile, and ensure it can realistically bring you to your desired target within your set time frame. So, and that brings us directly to the core truth of check number 1. Most of the retail damage I see in 7-figure portfolios doesn't come from picking the wrong asset. It comes from being structurally overexposed when the macro regime turns against you, and then having zero cash and zero framework to do anything about it. So structure first, always. Now let's get into check 2. Check 2. Here's what most people miss entirely. A portfolio can be beautifully built and still be completely wrong for the moment we're in. A portfolio that's perfectly for a risk-on bull market becomes a liability at a risk-off top. Same holdings, opposite outcome, just because the regime's changed. So the second thing I check is, where are we in the cycle, and does this portfolio actually fit? So I read the regimes as confluence of 3 things. We have 1, the business and macro cycle. Are we early, mid, or late? Are top signals starting to flag? Then we have 2, the crypto cycle, if that matters. Where are we in its own rhythm, bottom, middle, or top? And 3, central banks and the currency roadmap, because liquidity drives almost everything. Where's the dollar going? Where's the Japanese yen going? And so on. So when the central banks of the world tighten or loosen, or at least their forecast is changing, that tells you a lot about where capital is going to flow next. So when those 3 line up, number 1, the business and macro cycle, where we are, the crypto cycle, and where central banks are going. When those 3 line up as risk off, you protect. So you protect your portfolio, you prepare for that. That's what we have been doing for the last couple of months. And when they line up risk on, that's when you can press, right? That would have been 2020, for example, or going into 2023 again. You buy up the bottom and prepare for that major bull run. So the whole job is reading that confluence. It takes me personally a couple of hours a week, sometimes a lot less, and not 10 hours a day on charts. So let me show you how this plays out in practice. This isn't a prediction or recommendation. This is just how I've been reading it lately. So since around August, September of last year, 2025, the regime started signaling a clear rotation out of crypto and into metals, some safer equities, and even AI. And more recently, the traditional cycle and AI stocks started also flagging topping signals as well, which is exactly why I posted on X posted on X a post saying that the big short on the S&P 500 is starting. Now, Bitcoin specifically, I'll cover that one on the next slide because it deserves its own point. The takeaway here isn't do what I did; it's what I'm reading the regime. It's that I'm reading the regime and letting it tell me when to protect and when to press, instead of reacting emotionally to whatever's loudest this week. So, a word on Bitcoin, because this is where a lot of people lose money. Bitcoin is one of the best instruments out there, bottom to top, top to bottom, and the moves in between. You can make a great deal with it, as you may have seen from other videos here on this channel. But it only works if you're detached from it. The moment it becomes a religion, the hodl on matter, the hodl no matter, hold through an 80% drawdown mindset, whatever hodl cult you're part of, you've stopped being an investor and joined a cult. So it's not a cult, it's not a flag, it's a tool, and its job is to gain your buying power at the end of the day. So hold it when the regime says hold it, and rotate out of it when the regime says rotate. So that detachment is the edge to Bitcoin. When you understand that hodling is not the way, but to detach from Bitcoin and use it as a tool, as your vehicle to generate cash flow or buying power, however you want to see it, that's when you start winning. Then we have check 3. And this is the one I told you in the beginning would surprise you because it's the one almost nobody has. Everyone has an opinion on what to buy. Almost no one has an actual plan for when to sell and when to buy back. Opinions are everywhere, plans are rare, so this is what I'm looking for. So do you have an exit plan? An actual one written down, or just a feeling that you'll know when the time's coming? Because you won't. Do you know when you'd buy back in? Here's a mistake I see constantly. People try to time the exact bottom or exact top. Trying to perfectly time either will make you miss both. You freeze and you never act at all. Your chance to enter or exit slipped out of your hands within minutes. The professionals don't do that. They scale in and out in tranches deliberately. And then the quiet one nobody thinks about, do you even have enough cash, enough dry powder to act when the opportunity finally comes? Because if you're fully invested at the bottom, the best setup you'll see in years is completely useless to you. You're just a spectator. I think a lot of you guys actually feel like that, especially if you joined the last couple of years. Maybe you missed the top in October, now specifically talking about Bitcoin. And you're missing out now, right? Like Bitcoin is around 60K. It fell recently just below 60K. And maybe you already wanted to buy. I'm personally not buying here. But maybe you wanted to buy now. You're thinking, wow, these are great prices. Even a 2x from here would bring it to wouldn't bring it to all-time highs, but very close. So why not? And you can't buy it. You're fully invested in altcoins in Bitcoin and down. So it's always important to have some dry powder on the side. Understand when you should have cash and when not. When stocks, equities, equities, metals, crypto are overvalued, that you then start selling and buy again when they're undervalued. So have a plan, have dry powder, and that is what turns a market crash from disaster into opportunity of the cycle, And a quick story on this. I have an active, now successful client with us. He joined us last year, right before Bitcoin reached 120,000. And back then I would publicly post that I sold all my Bitcoin I'm short. If you remember, you can check that on X or here on my YouTube channel. I said that it is possible Bitcoin moves to 130 or even 140,000 before topping, but I already started selling and was short. And even if it does go higher, I wasn't interested to wait for that. I mean, at best, I have it here, it would have been an additional 17% if it would have gone to 140,000, and the very high risk that I missed the top completely, right? So why getting greedy and try to time perfectly? That's the good question, right? The client that joined us unfortunately did exactly that. He tried to maximize every dollar he put in. He read my research papers, saw my moves, saw my analysis, and for his personal sell target before even joining, he actually set 100,000 as his take profit, where he would sell everything. And that happened weeks and months ago, and he didn't listen to his own level that he set. Then it became 120K, and once it was reached, it became 130K, and from here he missed to sell, obviously. So over $500,000 down the hill from there. Now do the math. That's an 8% move on top, 120 to 130. Is it really worth it? I don't think so. So the risk was too high. Top signals were screaming, and I shorted. And even then, you can get very greedy. So you have to have a clear exit plan on paper and follow it religiously. You need to know why you exit at this point, what you're going to do with that money. Are you just keeping it in cash, or are you looking into some sort of rotation? And you need rules, right? If Bitcoin triples within a year and it makes up suddenly 80% of your portfolio, is that too much, right? When the top signals are flagging, the top is in, what are you going to do? Are you taking profits earlier or later, and so on? So you have to be very flexible, at the same time also be very rigid with your plan. You have to go by your exit plan and entry plan. So now let's step back and notice something. Not one of those 3 checks was what's the best coin to buy. Not one. It was structure, it was a regime, it was a plan. All 3 of them. That's the whole thing. That's what separates protecting and scaling serious wealth from gambling and hoping. It was never about the hopping. It's about the questions you ask before you ever make a move. Get those right, and the picks mostly take care of themselves. So to recap. 1, structure and exposure. How is it actually built? 2, the regime. Where are we in the cycle, and does the portfolio even fit it? 3, the plan. Exits, entries, and dry powder, all of it. Do you have a multi-cycle plan, and so on? I go through all 3 personally every single time, and if all 3 aren't right, I don't make one move. So that's discipline, and that willingness to do nothing until it's right is worth more than any prediction I could give you today. So if you've got a 6 or 7 figure crypto portfolio and you're a founder or executive who doesn't have time to live on charts, book a one-on-one strategy call with me. We'll walk through where I think we are in the cycle, how the framework actually works, whether it's a fit for your situation so you can run a clear system on about 30 minutes a week instead of reacting to noise. The link's in the description and pinned to the comment, or just go to sonderbergresearch.com. Either way, the one thing I'd ask you to take from this, start asking better questions before you make your next move. God bless you.